Good afternoon, ladies and gentlemen. Thank you all for taking the time out of your busy schedules to join our webinar today as we discuss IRAs and other US retirement plans for expats living abroad. Before we dive in, just a bit of housekeeping rules. I'm Cam. I'll be the moderator today, running the webinar and just going through a bit of housekeeping rules. Everyone should be on mute on the webinar, and if you have any questions, please feel free to use the Q&A function to ask your questions, or the chat, and we'll interrupt the speakers to get their thoughts on it as we go along. Please note we will have a dedicated Q&A section towards the end, so don't worry, we'll have plenty of time to answer any of your hard-hitting questions. Before we get started, just a few bit of pieces to go through for compliance, otherwise they'll have my head for it. Any information presented here is for educational purposes only, and it's not intended as a solicitation for any offer or any particular strategy. Before implementing any of these strategies, please actually consult with one of your qualified tax accountants or financial advisors. We've got two qualified individuals here on this call, so feel free to reach out to them towards the end. But before we dive off, let me just give a couple of introductions to our speakers here. So we've got David Bellingham, CEO and Director of Black Swan Capital. He's been advising international clients and heading up the financial services business for over 20 years across 3 continents since he commenced as a financial advisor in the 90s. So a wealth of experience there to go around, and I'm sure he'll have great insights to share today in our session. We've also got Anya, who is a certified financial planner at Dunhill Financial with over a decade of experience in the investment and banking industry. Anya herself is an American expatriate herself and enjoys assisting Americans who have made their home outside the US. Anya's goal is to simplify the financial planning side of things and all other aspects. With that said, I guess I'll hand it off to you, David.
Thank you very much, Cam, and nice to see you guys again. Thank you, everyone, for attending. Anya, hi there. Nice to see you again as well.
Great to see you, David.
Yeah, thanks. We're having a bit of a discussion today around IRAs and US retirement plans in a back and forth discussion. It's probably a good spot to start just by getting some key points down about understanding what IRAs are, the difference between traditional and Roth IRAs, and we know there's a few acronyms and terms there. Can you perhaps set the scene for us, Anya, and explain some of those key terms and what we're actually talking about?
Absolutely, David. Let's start with some of the basics. As you said, traditional and the Roth IRA are the 2 key terms that usually come up when talking about retirement plans for US persons. And so let's break it down. Let's talk a little bit about what are the differences between the 2 and how do they work. So let's start with traditional IRAs first. Generally, traditional IRAs are the type of an account that when you make a contribution into that type of an account, it could be tax deductible. So when making a contribution, you could be getting an immediate tax benefit on your tax return. However, later in life, when you take distributions out of that account, that is counted as earned income when that comes out on the back end. There is also a guideline around traditional IRAs generally that once you reach 72, even if you do not need any distributions, the IRS in the US mandates that you begin taking distributions really based on your life expectancy. And so the IRS essentially gets the tax dollars from that account that's been growing tax deferred for hopefully many, many years. Now let's compare and contrast this to another account type that's available out there in the States, and that's a Roth IRA. It's a newer account type where when you initially make a contribution to that type of an account, it's after tax. So there are never any deductions for making a contribution. There are also rules and guidelines, income-related guidelines as to when you qualify to make a contribution to a traditional IRA. You essentially have to have your income below a certain threshold to qualify. But once you do, and you have money in the Roth IRA, it is treated as after tax account in the US. meaning that later on in life, when you take distributions, the IRS is not going to tax those dollars. So it essentially grows tax-free. So it gives you a tremendous tax benefit to put money aside in a Roth IRA and let that grow longer term. Additionally, if we were to compare traditional to the Roth, there is no mandate to take money out of the Roth at 72. You could wait as long as you want, or never take money out of that and pass that to the heirs. So that's the main difference between those two account types. Again, to summarize, traditional IRA, you could potentially get a deduction for putting money in. When you take money out, that's taxed. Roth IRA, quite the opposite. After-tax contributions, and when the money comes out, tax-free. That's the general idea between the two.
That's a good summary. Thanks very much for that, Anya. So we've got a clear position now on traditional and Roth IRAs, and I'm sure we'll go into more detail on those. You've touched on tax, but what about tax from a US context, at least, when you start drawing income, if you choose to do so, as with the flexibility you've mentioned in the Roth IRA there?
Absolutely. So it's definitely an important point that you're making, David, that in the US, this is how taxation looks like. Of course, in a moment, we'll talk about if you're an expat living outside of the US, taxation could be slightly different. But let's talk about these aspects. So I'll start in the middle of this chart here with taxable accounts. Of course, these have the least tax advantage. So when you look at individual accounts, joint accounts, trust accounts, generally we call them non-qualified accounts. As they grow over time, any gains that are realized in those accounts are taxed. And so, for example, if you purchase $100,000 of S&P 500 ETF, and over time it grows to 150,000, that 50,000 growth piece is going to be taxed when you actually realize the gain. Again, those types of accounts give us the least tax advantage. That's why we definitely want to focus on saving in other account types that give us more tax benefits. The second best, of course, is what we call tax deferred accounts. So that's where the IRA fits in, your 401ks, traditional 403bs. Those are the different account types that fit in that bucket. Essentially, the general idea is that when you put money in, you get a deduction on your tax return, but when you take it out later on in retirement, distributions are taxed as income. But let's say that maybe you started when you were 25, you're waiting till you're 65, so you've got many, many years in between. And the main benefit of tax deferred account, as the name implies, you're deferring taxes of that growth to later on. So in that example of the S&P 500 ETF growing by 50K, that 50K is never taxed until you actually start taking money out of that account later on in life. So that's a significant tax benefit. Now, even better, there is another option, and those are tax advantage accounts over on the right side. So that's our that's our Roth IRA or Roth 401k or Roth 403b. And that is the idea where the money that we put in is after tax. There is no tax deduction. Let's say we start at 25, we wait till 65. All those years of growth, nothing is taxed. Even better, at the end, when you take the money out and you're in the US, the distributions aren't taxed either. So that type of an account gives us the biggest benefit. So whenever possible, we definitely want to focus on those types of accounts if we are qualified to make those contributions to those.
Thank you very much. And that certainly can make a difference if you just think about the compounding impact, and you maybe even touch on that later. But based on that, then we've got that understanding of how the tax works from a US perspective, and we know the different types. Can you tell us a bit about how they would work for US expats in particular, whether you're a US citizen or you're US connected in some other way and perhaps living here in Europe? Tell us a bit more about how these plans might work for US people.
Absolutely, David, that's really great question, because oftentimes I get asked whether US expats can even consider these types of plans or consider making contributions into those types of plans if they have no US sourced income. And of course, the general answer is yes. However, you want to be sure that you are meeting certain qualifications to actually make a contribution. So we'll start with contributions before we go to the distribution part. So maybe let's work through an example. Let's say you are a single individual living in Germany, for example, and let's say your annual income is 80,000 euros per year. Can you make an IRA or a Roth IRA contribution? We've created this chart that's in front of us right now. I hope you can see it relatively well, but we've created this as a decision tree to help you determine whether a contribution is allowed. So let's just work through this example of this US expat living in Germany. So of course, we've already mentioned they have earned income, 80,000 euros per year from, let's say, a German company. The next question we want to ask ourselves in this situation is, how is this person filing their US tax return? Are they using the foreign earned income exclusion, or are they using the tax credit? If you're using the foreign earned income exclusion on the left side there, the IRS does not allow a contribution. However, perhaps switching to tax credit could be advantageous. So it's a great question to ask your accountant, hey, if I do file my tax return using tax credit, is there going to be additional tax liability, or is it going to be roughly flat and the same? And if it is the same and the general impact is positive, then if you're using tax credit, you could possibly contribute. Now, of course, the next level on the decision tree is your US filing status. So we've already said for this particular individual, they're single, very straightforward situation. Could they then contribute to a traditional or a Roth IRA? Of course, Roth having a great after-tax growth in that account longer term is a great account to test first. And that really has to do with the income level. So if it's 80,000 euros per year, right now, euro and the dollar are roughly at parity at the time of this recording. So that person is under the threshold for when they can actually make a contribution for a Roth IRA. So they don't make too much is what I'm trying to say. So they could contribute to a Roth IRA if they wanted to. And as we've said, it's not tax deductible, but it could grow in a tax advantage way longer term and not be taxed. Now, I will put a side comment on this, because if this person stays in Germany, distributions out of Roth IRAs will be treated differently than if that person lived in the US or France or another country. So we'll talk about that in just a second. But I wanted to walk us through that example just so that we know that expats could possibly qualify for contributions. We usually test for a Roth IRA contribution first, just because traditional IRA contributions are generally not tax deductible for expats. Not always, but that's usually the case. I also wanted to point out in this specific example that we were just working through, let's say this US person is making 200,000 euros per year, and they went over the allowed threshold for when they can actually make a contribution to the Roth IRA. Let's say they make too much to make that direct contribution. There's also something known as the backdoor Roth in the States, meaning that highly compensated individuals could still possibly get money into a Roth IRA through this backdoor strategy, assuming that they don't necessarily carry balances in existing IRAs, SEP IRAs, or simple IRAs that could subject them to taxation unnecessarily. So let's say this is a really straightforward situation. US expat in Germany making 200K per year. They make too much to directly contribute to a Roth, so they contribute to a traditional, immediately convert to the Roth. That's called the backdoor Roth IRA, and then they've got this nice account that can grow tax-free longer term. So that's just one of the examples, but definitely a great question, David, about what can US expats do.
And what about at the time of retirement and drawdown when they're receiving income?
Mm-hmm. Absolutely. So that really let me switch back to the next one. That really depends where we live, right? So we discussed the part, if we live in the States, traditional IRAs are taxed as earned income when we take them out. If we live in the States, Roth IRAs are after tax when we take money out, assuming the 5-year rule is satisfied. And so that's the general gist of things in the States. The next category of countries, I would say, would be if you are a US expat, but you live in a country like France, for example, where as a retiree, all your income is still taxed in the States, assuming you have no earned income, but your pension, Social Security, IRA, Roth IRA distributions get taxed in the States. Essentially, the tax treatment is the same. And so that's one of the reasons why so many US retirees go to France for that huge advantage from a tax perspective. If we're looking at other countries, for example, Germany or the Netherlands or Spain or Ireland or some others, where distributions out of these plans are taxed in that country where a US expat lives, Germany, for example, those distributions would be taxed. And so this is a really important consideration, one for the IRAs, because generally tax rates in Germany are higher than in the States. So your IRA distributions would be likely taxed at a higher rate. And a very important point for Roth IRAs, of course, because Germany doesn't recognize that structure. So all that we've been talking about, that great advantage, doesn't really work if you are a tax resident of Germany. Those distributions would be taxed.
Yeah, it's a good point. From our perspective, and we deal with a lot of people, US connected people in Germany and in the Netherlands, and it's similar in both cases where the Roth IRA, because of the criterion for the definition of pensions in those countries, don't qualify as a pension, and therefore they're treated as an asset. Now, it doesn't automatically rule them out. It really must be said that we're talking in generalities here, and there are specifics for individuals that you'd need to go into to see if it were worth it or not for you to maintain it or to add to it if you could. A number of criteria about how long you intend to stay in that country, the opportunity cost, if you like, and where else you're going to be managing your money, if not in this pension structure. Where do you want to retire? And many people don't know that, of course, but they're important considerations. In Germany, there is a capital gains tax. It's very simple. It's 25%. And Roth IRAs, all capital growth in a Roth IRA can be, you need to get your specific tax advice, but can be, I guess, falling within that net of having to pay cap gains tax in Germany on that. That's something really important to consider as well. In the Netherlands, it's a bit different because there is no capital gains tax, but there is a wealth tax. And we'll get onto a few anomalies around that in a moment. But in the wealth tax, it's effectively, if you're from the Netherlands, you'll know box 3 when you do your income tax return. And you are getting taxed on what used to be a hypothetical return on your assets. And with some changes this year, it's going to be different, but you'll be taxed on that growth of your asset. Now, again, a Roth IRA is not considered a pension by the Dutch regulators. And so therefore, potentially you may be paying wealth tax in the Netherlands on your Roth IRA. So they're really important considerations. It doesn't rule them out automatically, but you do have to factor it into your cost of investment, if you want to call it that, and to the potential return you're getting.
Absolutely. That's a great point, David. We definitely want to, I always praise Roth IRAs, but we want to definitely remember the implications for US expats and specific countries where they live.
Right. Yeah. And as I say, it doesn't necessarily rule them in or out, but it is worth being aware of, I think, in terms of that system. The other thing that's worth mentioning in the Netherlands, to add another layer of complexity, or if you like, is the 30% ruling. And if anyone listening or viewing today is living in the Netherlands, will probably be familiar with this. The 30% ruling is a specific tax advantaged position for certain international professionals. And basically it means that whilst you're here, you get a 30% reduction. So if your income's 100,000, you're only getting taxed on 70,000. That in itself is quite nice in a high tax environment, is to encourage highly skilled professionals from around the world to come to this country. But more importantly, I think for many people is that because you're considered a partial tax resident, it means that you, for the most part, may not have to submit a box 3 on your income tax return. Therefore, you are excluded from wealth tax. So therefore, if you're here for 3 to 5 years and a 30% ruling lasts for 5 years, it's a different sort of analysis you're doing. So there's not a tax benefit potentially in the Roth IRA, but you're not having to pay wealth tax in the Netherlands on it either. So it makes it a bit more complex in deciding that. That may be for some people more positive reason for doing that. For others, not necessarily so, depending on where they're going next. But the 30% ruling is certainly a very important factor to consider if you're living here in the Netherlands and you're fortunate enough to be within that. You need to think about what you're doing once that expires as well, and then you all of a sudden are under the net of the wealth tax or the box 3 income report, asset reporting.
Absolutely. So that long-term planning is always key.
Absolutely, yeah. And I think the other point we should mention, Anya, is to compare it with the pension systems in the countries in which you're living, wherever that may be. And I'll keep using Germany and the Netherlands as the examples in today, although we could look at a whole number of countries, I guess. Both, in fact, most European countries have excellent pension systems. Usually there's a 3-pillar system that are very good. And in certainly the Dutch and German cases, that is the case as well. The pillar 1 is the state pension, which is basically that safety net, just to put enough bread on your table at retirement. In the Netherlands, you accrue 2% for every year that you are here and you qualify. So if you work for 50 years, you get 100%. 100% is something like 75% of the minimum wage. So it is small and it's not going to give you a lavish lifestyle. But you can accrue for this. And importantly, if you go from here and retire in France or retire back in the US, you can be eligible to receive it. You need to apply, qualify, potentially pay tax here and claim it through the double tax treaty, but you can still get that. And in Germany, there is a state pension as well, a mandatory pension, which your employer will usually deduct from your gross earnings and contribute to. Pillar 2 is your employer pension system. They are both fairly rigorous in both countries, and you may also contribute to those, or your employer may contribute to those for you. The difference, and the big difference between pension systems in, say, Germany and the Netherlands and the US are around age of accessibility and the manner of accessibility. And these are really important. So if you're thinking about, do I contribute back to my pension in the US to the extent that I can, or do I do it in the country in which I'm residing? You again need to think of those long-term points, such as when am I wanting to retire, at what age, and where do I think I might retire? Because whilst you've talked about before, I think the rules are 59.5 for a 401k, around about age 60 for the IRAs, depending on your situation, and you can defer them as Anya has mentioned and benefit from some compounded growth in doing so. In the Netherlands, it's currently in both countries, it's age 67, Netherlands and Germany. The Netherlands is heading up to age 70. So if you're a younger person today, it may be age 68, 69, or even up to age 70 before you can access that pension asset. And if you have aspirations of retiring at 55 or 60, you need to be able to fill in that gap between when you want to stop working and when the pension will pay you. The second big difference is about capital access. Because in the US, as you've described, there is some potential access to capital. Now, when you're doing long-term planning, you're always subject to the risk that a government might change the rules, but we have to go on what the rules are today. And as at today, that's the case. And as at today, in both, to a large extent, Germany and absolutely in the Netherlands, you don't have access to capital. So a pension is doing, in a pure sense, what it's intended for, and that is to generate an income for you at retirement. But it's not going to give you 50,000 to take a holiday, renovate your bathroom, and do a few lifestyle things. You can't do that. You are just drawing income. So that's really important to think about. I'm getting my money later, and I'm only and specifically getting income. Separate from that, and particularly in Germany, this is where it's good to get some specific advice, because if you're in Germany and you're getting an employer pension and a state pension, if you're a high income earner, There are other pillars in the third pillar that you may want to adopt or may get advice upon. If you're a high income earner or self-employed, you might want to look at a Basis or Ruhrop renter in Germany. You might want to look at a personal pension in the Netherlands. Again, trading off some of those tax deductions that may be available for you relative to the tax deduction you'll get in a different structure, and that different accessibility, and thinking very carefully about how long am I living in these countries and where do I intend to retire? Because certainly from the German side with a Basis renter, if you're not contributing to it for 5 years, there is really limited value in doing so. So you need to have that sort of a clear view. And we do know, if you're an expat or international, how hard it is to plan 5 years from now to know exactly where you might be, and even to be assured of employment stability across that period. So it can be complex and a lot of factors to consider. Do you want to add a comment on that, Anya, in the context of the pensions that are available in the US, before we go on to perhaps some of the key questions that are coming into us at the moment? We have quite a few questions coming in as well.
I would say, David, let's just jump right into the questions and we'll make additional
sure.
comments as they come in.
Yeah, sure. Do you have access to them as well, or shall I read them?
I can see them as well right here.
Yeah,
Shall we start with John's question?
Yeah, let's do that.
So John asks us here, what are my options if I would like to use IRA assets to purchase real estate? For example, if I wanted to use IRA to purchase, renovate, and sell a property in which I would not live or use. So generally, David, did you want to take that question or should I?
Go ahead.
Okay, sounds great. So John, thank you for that question. It certainly is a really, really good question. Generally, oh, actually, it looks like Brian would like to answer this question live. I wonder how we make Brian, how we unmute Brian. Cam, I'm sure Cam can help us there. Yep.
Yeah, just give me one moment while I shift Brian here from an attendee to a panelist, if I can find him. Or maybe he's under a pseudonym. Can't seem to find him. Okay, looks like I can't find Brian in here unless the two of you can see him. Yeah, I don't think I can see him here. Well, looks like you're gonna have to take this one, Anya.
No problem at all. Definitely didn't want to take it from Brian if he wanted to answer, but most definitely. So John, there are certainly options to use your IRA assets to purchase real estate. Of course, generally we would say set the IRA assets for the long term, allow them for long-term growth. If, of course, you were to use something such as Forge Trust, for example, where you take the money out and really use it outside of your IRA, you can't do that, but you are limiting the growth within those assets. So unless this is a situation where maybe all of your assets are tied in an IRA or a Roth IRA, you have no real estate, no taxable assets, I would leave that maybe as last resort, because again, while you could do that, you're definitely limiting the long-term growth in those accounts. So it is possible, case by case. I would say we'll take it on case-by-case basis, whether it's advisable.
Perfect.
Okay.
Thanks, Fred, for answering that one. There's a few questions here that I think are pretty much focused in your area of expertise. So I'll ask Jennifer's question to you about, can you use the FEIE and make Roth IRA contributions based on any excess earned income? Do you have to use the full FEIE even? And again, if you have ability to speak, I'm sure you've got lots to add as well. Otherwise, Anya, if you want to lead us on this one.
Absolutely. I'm happy to take that question. And Cam, if you're able to find Brian who wants to help us answer those questions, please do. But Jennifer, that's a great question. So essentially, when you're filing your tax return, generally using FEIE, we would say generally you wouldn't be able to make a Roth or a traditional IRA contribution. However, if you are a high income earner and if you are essentially, you cannot exclude all of your income on the US side and make a contribution. So let's say you do make 200K a year and you're only excluding up to the exclusion amount, which is roughly 112,000 right now, then of course you could use the excess income then to say there is earned non-excluded income on the US side. And that would be one special scenario where you would be making a contribution to a US retirement plan filing with FEIE. However, whether it would be a contribution to a traditional or a Roth IRA would really strictly depend on your income level and your filing status, right? Because we want to be sure you fall below these thresholds for when contributions are allowed to a Roth IRA. I'm sure that after today's event, we'll share that chart that I was showing as far as the decision tree for making a contribution. So we'll be happy to share that with Jennifer afterwards as well.
Very good, thank you. And there's another question coming about US Social Security payments, and the question is how are US Social Security payments I might receive impacted by living in France, and do they qualify for the exclusion? Is that something you can answer on, or is that something we can go back to John on?
I will say that generally, based on the tax treaties between the two countries, my understanding is that Social Security payments would also be taxed on the US side. So of course, depending on the size of these Social Security benefits, they would be taxed in a different way. As far as the exclusion, I'm not sure what John is specifically referencing. So John, if you want to give us more background on which exclusion you're referencing, we'll be happy to address that.
Perfect. And a couple more questions. There's one around IRA distributions being treated the same as Social Security in the context of their taxation or not being taxed, more to the point, in France.
So Social Security taxation and traditional IRA distributions, if you're living in France, are all taxed on the US side. However, they are taxed differently. There's different thresholds depending on how much Social Security benefits you're getting, what age you are, whether you have earned income, that play into how Social Security is taxed versus traditional IRA distribution. If the entire account is pre-tax, they would be taxed as earned income on the US side. And of course, depending on the size of the distribution combined with the size of your Social Security payments, that's what would help determine your tax liability. And with that, I should make a disclosure that I am certainly not an accountant, so this is general advice. If you do have specific questions or if you'd like to calculate your specific tax liability, and that's the answer to Bill, then I definitely seek also professional tax advice on that.
Good one. Thank you for that, Anya. And a really good example in the question here of an expat or a person who's lived in lots of different places, as many of you will see clients, and we've seen clients do. This is someone who's lived in the Netherlands for 5 years, Sweden for 5 years, Norway for a number of years, and are now back in the US and retired. And the question is, how do they deal with taxes and totalization agreements in that context? Because that becomes rather complex, doesn't it?
It certainly could. So from one perspective, it's complex. From the other, you're going back to the US where the code is, at least to me, pretty clear as to how that's going to be dealt with. So when you're back in the US, you're back on the US rules as far as what we talked about, traditional versus Roth distributions and taxation. So this would depend, Renata, who asked this question, whether you also have pensions from these other countries, right? So whether you have a pension from Sweden, whether you have a pension from Norway, and how these tax treaties look like with the US for those specific countries where you lived, and if you had pensions from those countries. So again, for details, I would definitely defer that question to a tax advisor.
Good. Yeah, good advice. And perhaps just one last question then about excluding just enough earned income to allow for sufficient leftover taxable income to make IRA contributions. Is that possible, or are you required to use the full extent of the exclusion?
Let me see.
Again,
Sorry.
Brian may be typing a response at the same time as we're speaking. And so you may get a direct response, Jennifer, on that as well. Otherwise, we can come back to you if we can't answer it directly now. And we may do that. If there are any more questions, we're very happy to take a few more questions. I think we've answered those that came in through the session. We are happy to take some more questions, though, over the next few minutes of this presentation.
Perfect. Well, I just want to give a thanks to both David and Anya. That's a super insightful session there. Hopefully the audience found some useful nuggets of information there. And some takeaways. But in the meantime, as David said, we're more than happy to take some questions. The last couple that come through, again, feel free to use the Q&A function and the chat. And while we give the audience, a couple of minutes to ask any last minute questions they want to ask, I do want to say that a recording of this session will be available to all attendees and registrants, and we'll also be sending out a more comprehensive deck of the slide deck that Anya was using, especially with the flow chart on whether you're eligible to make contributions or not, and we'll also have the details as well as the contact information for both David from Black Swan Capital as well as Anya. So please do feel free to reach out to those respective professionals, to discuss your specific situations and get more detailed advice. It looks like we've had 2 more come in. Any ideas where I can find an expat tax advisor or an expat financial advisor from Renita? Well, I'll take a part of that, I suppose. Well, we've got David here again, who specializes in helping expats with their financial advice. So I'm sure he's got a wealth of information and expertise to share with you, Renita. So you can definitely get in touch there. As for expat tax advisors, again, depending on your particular country that you're from, again, more than happy to make a recommendation based on where you're living and where you intend to retire. So again, more than happy to make a referral to the appropriate person. And then we've got one. Perfect. Okay, it looks like that's it for all the Q&As. But again, I just want to give a great shout out and a thanks to both Anya and David for the super insightful session. But if we have no more questions, I guess we'll keep it nice and short, and we'll be concluding the webinar here. And again, everyone will be getting a follow-up shortly thereafter.
Perfect. Thank you so much.
Thank you so much. A pleasure to be involved, and great to hear the information. I always learn something in these discussions as well. So thank you very much. Perfect.
Well, have a wonderful rest of the day, everyone. And feel free to get in touch with the appropriate professional. Thanks so much, Anya. Thanks, David.
Thanks.
Pleasure.